What's going on, guys? Ryan Martello here at the Crypto Fiend Studios, bringing you guys the hottest, the latest, and everything crypto related news. Today we're going to be looking at 5 different indicators that can help greatly improve your trading skills as well as your profits in cryptocurrencies. Now, this was a widely requested video, and I'm more than happy to be doing it for you guys. So if you ever have any video recommendations, please leave them in the comments below, and I would be more than happy to consider them for a future video. So first off, we're going to be looking at what these indicators are and how they work, and then we're going to apply them to some moving charts to show how we can all use them all together to help greatly improve your buying and selling skills. So first off, we're going to be looking at the moving averages. The moving averages is definitely an indicator that you want to be using on your charts. So we have the 50-day, the 100-day, and the 200-day. So what these are mainly used for, they help determine the general area that a given cryptocurrency or stock, but we're talking about cryptos for this video, of course, the given area that the cryptocurrency is going to be trading in to help greatly simplify the chart that you're looking at. So what I mean by this is that you can see that we have this green line, which is the 100-day, blue line 50-day, and red line 200-day. The given cryptocurrency you're looking at right now, we're looking at Bitcoin, is going to be trading relatively in between two of these 3 lines. So right now it's relatively trading between the 200-day and the 50-day. Also, these indicators are greatly used as support lines. A lot of traders do use the moving averages, so it's kind of like human psychology that the indicators are used as support lines. So if right now Bitcoin is trending downward, if Bitcoin does continue to trend downward, Bitcoin can hit this 200-day, and the 200-day could act as support for Bitcoin and ricochet it back upward into the green. We also have the 50-day coming downward. If the 200-day and 50-day do meet and cross, that could be a double layer of support for the price movement of Bitcoin, which of course can move it upward. Now, before we continue into any of these indicators, I want to stress this enough that these indicators are not bulletproof. Anything can happen in cryptocurrencies in general. So I just want you guys to know that anything can happen. These aren't bulletproof. This isn't fully saying where the price is going to be going, because as you can see on February 5th, when we had this huge dip in crypto, Bitcoin completely plummeted through the 200 days. So this is a good example showing how these indicators aren't 100% bulletproof, but they are up there to greatly help improve your buying and selling skills and determine good prices. So that's that. The next indicator we're going to be looking at is going to be the MACD. Now, I did a video on the MACD probably about a month or 2 ago. So if that one goes into greatly more detail on what it is, how it all works, but I'm going to sum up the MACD for this video just because we have a couple others to do. So the MACD is mainly used to determine new trends happening in the market as well as the volatility. So as you guys can see down here, we have this blue line and this orange line. We also have these pink lines up and down. This is called the histogram. So as you guys can see, the pink lines that are moving on the upper side, that's the positive side, the green side. And then you have the negative side, which is obviously down here. You have these 2 lines trending along this histogram. It's called a histogram. And one of these lines is chasing the other. Now, again, I'm not going to go into great detail, but what these lines are showing is the closer they are together, the more likely a new trend is going to be happening. The wider they are apart, the less likely a new trend is going to be happening. So what I mean by this is if you look right here, the 2 lines are relatively far apart. This is showing that there's mass volume coming into that cryptocurrency, as well as a trend is in place and a new trend is most likely not going to be happening at that given time. Now, as you can see up here, the orange line crosses over the blue line, indicating a new trend is coming into play. So right when that happens, right when the orange line crossed the blue line, a new trend happened. And as you can see from up here, a new trend happened and Bitcoin went down. So this is a great way to show new trends as well as the amount of volatility in the market at a given time and what you could be seeing in the future. So again, as wider apart the lines are, that's an indicator that a trend is in place and a new trend is most likely not going to be happening at that given time. And then as you can see, when the orange line crossed over the blue line, that means a new trend is happening. And as you can see, a new trend happened and it went down. Now, how the histogram is used, this is showing that the lines going upward is an upward trending movement, lines going downward, downward trending movement. Right when the orange line crosses over the blue line, the histogram flips sides and it moves to the negative side from the positive side. So that's the MACD summed up for you guys. Again, it's a great way to show trends happening in the market if you're getting into a cryptocurrency on the negative side at the best price possible at the given moment, or if you're getting in at the positive side, or when a new trend is going to be happening. So the next indicator we're going to be looking at is going to be the RSI, Relative Strength Index. Now the RSI, let me get rid of this one. The RSI is mainly used to show if a cryptocurrency is being traded at its value, if it's being traded undervalued, or if it's being traded overvalued at that given time. So how this works is that you have this purple rectangle here. Right on the side, you have these numbers. You have 30, 40, 50, 60, 70, and the rectangle ends at 70. So this rectangle is the perfect width of the value that a cryptocurrency should be trading in, that it's worth at the given time. Now, if a cryptocurrency goes over the 70 mark, that means it's overvalued. If it goes under the 30, it's undervalued. So if we look at the past with this purple line, you can see right around here on November 25th, Bitcoin broke through the 70 into the danger zone of being overvalued. And that's exactly when we had this huge run up all the way to 20K. So Bitcoin broke through the 70 and was trading greatly above the 70 for quite some time before it broke back down through into the safe zone. Now, again, that's indicating that Bitcoin was being traded way overvalued at that time. You would not be wanting to buy into a crypto at anything above 70. You would want to be selling above 70 because you want to get the most bang for your buck. So if you're a day trader, a week trader, etc., you would want to be trading, you would want to be selling above the 70. If you are buying, do not buy above the 70. You buy in between the purple rectangle or below the 30. Now, if you guys can see down here, right here, and then further on in the past, but right here, where is it? Right here, we could see that Bitcoin broke below the 30. That's when we had this huge dip recently. That's a perfect time to get into any cryptocurrency. That's when a cryptocurrency is being traded undervalued, not what it's actually worth. So that's really the RSI for you guys summed up. It's a great way to show if a cryptocurrency is being traded at a valued level of what it's worth, if it's overvalued or undervalued at a given time. So the next indicator I want to show you guys is one that I think is relatively underutilized and provides a lot of valuable information. Bollinger Bands. Bollinger Bands are a great way to show the volatility as well as potential breakouts happening in the market in a given cryptocurrency you're looking at. So to sum up very brief for you guys how Bollinger Bands work, you have this red line trading in the middle. You have these two blue lines right outside of it. Those are deviating away from the red line. The closer together the two blue lines get means that there's very minimal volatility in the market. The wider the lines get means the more volatility in the market. So right over here, if these two blue lines are very close together, they're practically pinching each other, that's showing that there's not a lot of volatility in the market and there needs to be volatility. It also shows you that there could potentially be a breakout happening soon. And that's exactly what happened. Right after this pinching movement of the Bollinger Bands, we had this huge breakout in cryptocurrencies, in Bitcoin. So as these two blue lines get wider apart, that means the more volatility that is in the market. Now, if you were to be buying using the Bollinger Bands as an indicator, you're going to want to buy when the lines are very close together because there's not a lot of volatility, as well as there could potentially be a breakout for that given cryptocurrency in the future. Also, if you were to be selling, you're going to want to sell somewhere in the thicker side of the Bollinger Bands, obviously in the green. Now, as you guys can see, the candlesticks are relatively trading in between the blue lines. So you could see that the blue lines are kind of an indicator of where the price movement is generally going to be going for that given cryptocurrency. Now, again, these aren't bulletproof. So what I mean by this is right around here on December 7th, the Bollinger Bands, this candlestick broke through the Bollinger Bands. So this is showing that there was so much volatility in the market that the Bollinger Bands didn't predict it. So of course, if you were selling, you would want to sell outside of the Bollinger Bands on the upper side, of course, not the downside. You would want to sell on the upper side to get the most bang for your buck. But anywhere in the width, the wider part in the green, of course, you would want to be selling. So again, this is a great way to show the general area where a given cryptocurrency is going to be trading, as well as shows the volatility and potential breakouts happening in the future for that given cryptocurrency, whether the breakout is up or down. So those are the 4 indicators I just showed you guys. I showed you the MA, which is the moving average, the MACD, which is the moving average convergence divergence, the RSI, which is the relative strength index, and then the Bollinger Bands. The 5th indicator that I'm going to be talking about isn't necessarily an indicator. It's going to be called confluence indicator. What this means is it's more of you utilizing all these indicators together. So confluence indicator means using multiple indicators at the same time, whether it's Bollinger Bands, the RSI, the MACD, and the moving averages all at the same time to provide you the most information to determine the best buying and selling points. Now, when utilizing all the indicators at the same time, you're going to want to make sure that they all provide the correct information. So kind of like it all lines up. Think of it as like a checklist. Make sure that the Bollinger Bands are, if you're wanting to buy in a cryptocurrency, make sure that the Bollinger Bands are pinching very relatively close together so there's the least amount of volatility and the greatest opportunity of a breakout happening. Make sure that the RSI is trading between either below the 30 or in between the 30 and the 70. Make sure the MACD is on a negative trend downward because you want to get that best buying opportunity possible. And make sure that the moving averages are relatively supporting the given cryptocurrency that you're looking at, so you can also see the range that the cryptocurrency is most likely going to be trading in that given time period. Now, when you're trying to sell into a cryptocurrency, sell out of a cryptocurrency, best way to utilize all these at the same time. The Bollinger Bands, you're going to want to sell when there's a lot of volatility. Obviously, you want to sell on the green side right around here, not on the red side when you're going down. You want to sell on the green side. Now, if the candlesticks do break upward out of the Bollinger Bands, that's an awesome time to sell because most likely they will fall back down into that range. Now, with the RSI, you're going to want to sell above the 70 at the overvalued range. And with the MACD, you're going to want to sell in the positive upward trending movement, not the negative side of things. And with the moving averages, you're going to want to make sure that the overall cryptocurrency you're looking at is moving upward in the market, and those moving averages are definitely having some sort of support on the given cryptocurrency. So that's the video for today, guys. I hope you enjoyed this one. If you have any questions at all, please leave them in the comments below, as well as leave questions about indicators that you guys use, videos you would like to see on those indicators, etc. So I hope you guys enjoyed this one, and I will catch you in the next.